Hi, I'm Alex, welcome to the channel and thanks for tuning in. So in today's video we're going to be talking about a new SPAC to the channel. It's one that's in a hot sector that's already had quite a lot of attention, and it's one that it seems quite a lot of people are excited by. It's another LIDAR SPAC, and it's Colonnade Acquisition Corp, or ticker CLA's, merger with Ouster. Now I may have pronounced that name completely wrong, so apologies if I had. However, I'm going with that and I'm sticking with it now. Now this year has been really hot for the LIDAR space, specifically around SPACs. There's been a couple of completed mergers, there are a couple of others which are going through the process currently, and now there's this one. In this video, we'll look at everything which we need to know about the company, about the SPAC, the investment merits, the investment risks and the mitigants against those. So if you are interested in this company, then this video is definitely one for you, so stick around. We are going to talk about a couple of things which I've not seen anyone else mention about on YouTube, but which are really important to the investment case, so you don't want to miss that. If you're new to the channel and you like investing related content, then hit that subscribe button. As always, these videos do take a lot of work and research, so if you do appreciate that, please smash the like button. It's so helpful in pushing the channel to a wider audience. And as always, I'm not a financial advisor. This video is purely for educational and entertainment purposes only, but let's get straight into it. So who is Ouster and who is CLA? Ouster is a LiDAR developer and manufacturer. LiDAR is basically the light version of sonar and radar. Very simply put, LiDAR is the process of casting out light waves, measuring how long it takes to get a reflection back, and then using that to determine the proximity to other objects. It's a recently developed tech and it's a really high growth sector at the moment. It has a lot of applications. The main one that people seem to talk about is autonomous vehicles. However, it has applications in many other fields. Surveillance and monitoring in autonomous drones, manufacturing through RPA. There's loads of applications and it really is quite an exciting forward-leading sector. Now within LiDAR itself, there are a number of different technologies and ways which can be done, and we'll come on to that and why that's important in a moment. But Ouster's technology is a 360-degree LiDAR, so keep that in mind. Now Colonnade Acquisition Corp, or CLA, is the SPAC which is merging with it. Very quickly upon news of this reaching the market, the share price jumped quite materially. And personally, I don't think many people investing in it had time to read the investor presentation by this point. I guess that in itself is just a sign of the market we're currently in with SPACs. So my one warning to everyone watching this video is to always do your own due diligence. Making an investment into a company without knowing anything about it is ultimately gambling. Whilst it might work sometimes, it's not a successful long-term strategy. If you do your own DD, if you learn about the company, you're much less likely to get burnt. So what are the investment highlights? What are the investment merits here? Well, the first one we've touched on already is the high growth potential of the LiDAR market. It's seen massive growth historically and it's forecast to see even greater growth going forward. This growth comes from multiple end markets. It's not reliance on one sector, for example, the autonomous vehicle market. It really is growth across a number of sectors, and that's good. For companies participating in a high growth market, that's great. It means they can generate great growth without having to capture additional market share. What's exciting, however, is if the company does have a competitive advantage, it's able to win market share and grow in excess of the market growth. Personally, when I'm investing, it's always important for me to see that the company I'm investing in does have a competitive advantage and does have a reason to exist in the long term. I don't like fads and I don't like short-term trends. There's just too much timing risk around that. Now the next up is the strong customer proposition that Ouster has. Now, I don't want to get too involved in the technical side of it here. However, I mentioned that Ouster has a 360-degree LiDAR technology. That's very similar to Velodyne, who themselves actually pioneered the 360-degree technology. Velodyne itself is quite focused on the autonomous vehicle sector. There are other sorts of LiDAR technology. However, Ouster's primary competitor is Velodyne. Through developing its own IP and manufacturing know-how, Ouster has developed the 360-degree spinning LiDAR technology in a way that enables them to manufacture it much more cheaply than Velodyne, much more efficiently, and which means ultimately they can sell it for a lower price than Velodyne. Now this is massively important for their customers. Let's take a step back and think about this. For customers using LiDAR, that LiDAR is a mission critical component of what they're manufacturing. As with all manufacturing, areas where you can reduce your costs ultimately means that you in turn can generate stronger margins. Ultimately for those customers, if they sell the product for cheaper, they'll have more demand. So the end customer and Ouster's customers themselves are all price sensitive by nature. That comes as a function of these being capital purchases. Now another real positive I see for Ouster here is its diversification versus its peers. Now a number of its competitors are almost solely focused on the autonomous vehicle market. Now don't get me wrong, that's a great market to be focused on, it's high growth. However, diversification is always good. Personally, I think this is especially important when you think about the auto market. It is very correlated to economic performance and is inherently cyclical. Demand and production are directly correlated to economic performance. For consumers, purchasing a new vehicle is a discretionary expenditure, and during economic downturns, when disposable incomes fall, demand falls. You only need to look back to 2007, 2008 to see the slump in demand for new vehicles, so that's an important reference point. Ouster being more diversified is really positive. It does have alignment and customers in sectors which are less cyclical, for example remote monitoring, Security is a mission-critical service. Companies won't scrimp on their security unless they really, really have to. It's one of the last things that will go. So that provides more resilience to cyclicality, which is good. There's even some circumstances where this remote monitoring is required by regulation. That's even better, that's even more resilient. If you don't do it, you risk massive, massive fines. So I like the fact that Ouster is aligned to some of these sectors, albeit perhaps with a small presence at this point in time. Having greater diversification also gives Ouster a larger number of customers to chase after. It means that in certain end markets they'll face much less competition, and ultimately, less competition can mean higher margins. What's also positive about Ouster is they have a proven team and they have a proven model. They have a good sales team who are proven and have a track record of winning new customers. They have a proven track record of developing new products and creating new IP, which itself increases the barriers to entry. And they have a really exciting growth plan. However, one thing to note here is that they're not cash generative at the moment, so there is a cash burn issue. This is important to keep in mind and we'll come back to in a moment. The next positive I see is actually around the growth plan itself. Now, when reading investor presentations, you always have to take this growth plan with a pinch of salt. It's an absolute best case scenario. However, what I like in this instance is that the plan is all developed on the basis of customers that they have at this point in time. To deliver this plan, they don't need to win new customers, and that's good. They don't need to enter new markets, enter new geographies. It's a very tangible growth plan, and that's good, especially when you look at that in light of recent new customer wins, recent new product development, and recent new market entrants. This is all really positive, and personally I like this. The transaction dynamics are also fairly good. Management are rolling 100% of their proceeds, which shows they are 100% aligned to delivering this plan. They're not taking life-changing money off the table now. They really are all in over the coming years, and that's good to see. Now, we touched on the cash burn element before. However, as part of this transaction, cash is being put on the balance sheet to fund that, and that is good to see. That in itself gives me confidence in the competence of management. Now, one other thing worth thinking about is the valuation. Is that actually versus peers on a relative valuation basis, there does seem to be further upside in valuation there, which is always good to see. However, that's something that we do need to dig into deeper. So now, what are the main risks I see and what are the mitigants against those? So the first risk is the competitive nature of the market. There are lots of competitors who are all trying to win new customers in the market, and ultimately the competitive behaviour of those peers can impact every business in the sector. For example, a competitor reducing their prices, which to compete every company has to lower their prices, ultimately means margins are reduced across the board. Now, in part this is mitigated for Ouster by the diversification it has across end markets. However, you can't escape that in all end markets, especially the more competitive ones such as autonomous vehicles. Now, the next risk that needs to be discussed is the tech risk. The risk that the existing LIDAR technologies can be completely displaced by new technology. Now, this is somewhat mitigated by making sure that you have your finger on the pulse in terms of new product development, you have a good NPD function, and Ouster definitely has that. But as investors, this is something that we need to be aware of and keep a close eye on, because a disruptive technology into the sector could really have a meaningful impact on valuations. Now, the next risk I see is the continued requirement for new product development. Now, this is required to deliver on the growth plan management have put forward, and whilst they've done it historically, there's no guarantee they do it going forward. There's an ongoing requirement to continually be improving your products. That's not dissimilar from the model that Apple used with the iPhone, for example, every year bringing us a new model with very marginal improvements over the previous model, but it keeps competitors on their toes, it maintains that competitive advantage, and it's much harder for its competitors to keep up with versus a company that's sleeping on its existing technology, resting on its laurels, and getting completely displaced. So ultimately, as a mitigant, I do think Ouster are taking the right steps here. However, it's something that we as investors do need to keep in mind again. Now, the next risk that needs to be discussed, and that some people won't perceive as a risk but others will, is the product nature of the revenue. Ultimately, revenues are generated from the one-off sales of products. These are large sales and themselves have sales cycles associated with them. As we discussed earlier, a number of the end markets are cyclical as well. So in turn, revenues will be cyclical, and given the large fixed cost base the company operates with, so will margins and profits. Now here we really need to think about how the business may perform in a downturn, especially given where we are in the current economic cycle. A downturn would lead to a decrease in demand, which in turn would lead to a decrease in revenue, and on the bottom line ultimately impacting the level of cash which a company is generating. A decrease in that would mean ultimately the level of cash burn is higher, and perhaps under some circumstances would require additional funding from investors, perhaps through an equity raise, for example. So personally, what are the next things which I really want to understand about this company which I haven't yet got my head around? So the first of these is the product lifecycle, and then also the replacement lifecycle. Understanding this is so important to understanding how the business is going to grow. How long do these LiDAR products last for? How often do they need to be replaced? How long does it take to sell these products to a customer after the initial introduction? Of the new customers which Ouster's recently won, what percentage of those are customers which they're replacing someone else's LiDAR with versus new installations of LiDAR? All these things are so important to understand. The second risk, which is always important to think about when you're looking at a product-based company, is the warranty risk. Are there any histories of warranty claims, and are there any risks around that, which could ultimately have a big negative cash impact on the company? So, what am I doing? So personally, I think the LIDAR focus and high market growth potential should in the near term drive positive price performance. However, for personal reasons, and I'll come on to those in a moment, I'm not making an investment into this SPAC. I may well miss out on some great upside here, but personally, the pain of losing capital is much greater than the pain of missing out on upside. As an investor, I don't typically like product businesses. I don't like the one-off sales nature of the business. It's lumpier. I feel there's too much risk around the cyclicality and the volatility in the business. There's not enough resilience for me, which is something that I always look for. And personally, as an investor, part of my own investment criteria is investing in businesses which have really strong resilience. So typically, I don't invest in product businesses which have one-off sales. Now, anyone who's watched this channel before may rightly point out that actually I have invested in product businesses before, for example, ChargePoint or STEM. However, with those businesses, they had a subscription element to them, which gave them a recurring revenue and which ultimately gave them a greater degree of resilience. I also felt that in those instances, the end markets were much more resilient and didn't have the same link or connection to discretionary expenditure. That being said, the current state of the SPAC market, I'm sure I'm going to miss out on a great run up here. So everyone who's invested into it, I wish you the very best of luck. I hope you generate some great returns. But look, thank you so much for watching. I hope you enjoyed the video. If you did, please smash the like button. If you're new to the channel and you like investor related content, then hit subscribe. And as always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear everyone's perspectives, the debates, all the discussions, so please get involved. But thank you so much for watching, and I'll see you in another video.